Economist Steve Keen says not only has the coronavirus inflicted an unprecedented shock on the global economy, but he says the world's response to it, particularly in America, has been nothing short of a catastrophe. Even if the health crisis subsides, Steve sees a larger financial crisis looming ahead in 2021 for the tens of millions of households struggling to get by. Why is he worried about this? Keep watching this video to find out. And as always, please take a second to click on the like button below to help us continue the run of amazing guest experts that we've been having on this program. The more likes these videos get, the more big names we're able to attract. And now, let's start watching this week's market update video featuring economist Steve Keen. Hi folks, Adam Taggart, co-founder of Peak Prosperity here, welcoming you back to another week of making sense of these markets. This week, we're joined by Steve Keen. Steve's an economist, having previously held professorship positions at London's Kingston University and the University of Western Sydney. He's also the author of the books Debunking Economics and Can We Avoid Another Financial Crisis? Steve's been very vocal in accusing conventional neoclassical economists as having led us blindfolded into the 2008 Great Financial Crisis, and that ever since they've continued to defend a methodology that is utterly inappropriate for the economy and dangerously misleading about the relationship between the economy and the ecology of our planet. You can tell Steve's very like-minded with the peak prosperity mindset here. He focuses his efforts in creating a realistic system of economics to replace the delusional theories that have led us into the mess that we're in. Steve, it's a pleasure to welcome you onto the program. Thank you for joining us from Thailand, no less. It's quite late your time. Thank you for staying up late, and we'll try to respect your time as best we can here and being as concise as possible.
Fine, well, I'm glad to be back on again. You guys are part of the reason I'm here, because you alerted me early enough to the coronavirus and the problems it would have, and in deciding where I would live it out, the last place on the planet would be the Netherlands or the UK, which are actually doing worse than America now. Thailand is doing fine, so we moved here.
Well, great, and beautiful place, and glad to see that you've been able to stay safe. And if we've played any small role in that, that's a huge honor to hear. Let's get started. Real quick, we are also joined, as always, by the lead partners of New Harbor Financial. That's the financial advisory firm officially endorsed by peakprosperity.com. We've got John Lodra and Mike Preston both with us this week. Hi, John and Mike.
Hey, Adam. How you doing? Hello, Steve.
Hello, Adam and Steve.
Great, and guys, as we usually do, we'll tackle Steve first, and then once we say goodbye to Steve, you guys and I will touch base on what the markets have done since we got together last week. All right, and without that out of the way, let's jump straight into the material here. Steve, I usually start by saying, without introducing any of my biases, but given your intro that I just read, it seems like our biases are probably pretty similar. But still, without asking any leading questions, what is your assessment of today's economy? Should people be feeling optimistic or perhaps more worried?
I'm still worried because this is an unprecedented shock in terms of the impact of the physical economy on the financial system. It's normally the other way around. The crisis in 2008 was caused by the private credit system lending too much money. And then when the credit went from positive to negative, it dragged the real economy down with it. This is virtually the only time that what a neoclassical economists think causes crises actually occurred. And that's what they call an exogenous shock. So the coronavirus comes along and completely scrambles, not just the demand side of the economy, which is what normally happens with the financial crisis, but the supply side as well. Now, this crisis is not the sort of thing capitalism can handle on its own. You need a system which can create money without making a profit, and that's the government. And it would be quite feasible for the government to provide the cash flow needed for people to meet their current financial commitments, to buy the food they need to buy when they can't work and earn a wage to pay for that food, etc., etc. So if we had a sane understanding of the role of government dominating how politicians behave, then we could have given people the cash flow to tide them over through the shock of the coronavirus lockdowns. That hasn't been done. It's been done in a sporadic, panic-stricken and incomplete way. And at the same time, people are still accumulating financial commitments that they had during the crisis, deferred rents, deferred mortgage payments, and so on. If we ever get out of the coronavirus crisis, then we're going to be into a financial one, because those supports will be pulled away, and then people will be living with far less cash flow than they had before the crisis, while still having the debts, which would have been increased by the necessary debt extensions during the crisis itself. So we're nothing like out of the woods, and I think particularly America. I mean, I've never seen as well organised a catastrophe as your response to COVID.
That's a great way to say it, a well-organized catastrophe. Well, great point, Steve, and boy, I want to tear into several things you just mentioned there. I guess let's start with the aftermath of the stimulus. So, we have had a tremendous amount of stimulus here in the States, but as you said, I think it's been very poorly applied, right? Mm-hmm. In most cases, a lot of that stimulus has gone into the pockets of a relative few, and the many people who have needed it have gotten little more than some additional unemployment benefits and a one-time check so far of $1,200. Mm-hmm. And as you mentioned, they're still having to pay their rents and try to service their credit cards and all that stuff, and so are probably getting out of this with a worse household balance sheet than they went into it. And of course, tens of millions of people have lost their jobs, and a number of those jobs, a meaningful percentage quite likely, are probably not going to be coming back. Mm. So you said going from a health crisis to a financial crisis. Can you be a little bit more specific about let's hope for a second that the health crisis part of COVID goes away in early 2001. Where do you see? 2021. Sorry, 2021. But where do you see the state of the economy? Like when you talk about this crisis, what are we talking about? Are we talking about additional job losses? Are we talking just about super slow, maybe continued negative economic growth? Like, how do you think that's going to manifest as households struggle more under this greater burden?
Well, the main thing I'm concerned about is the level of private debt that America still has after the financial crisis back in 2008. So that was what I was focusing on, saying that was going to cause the crisis before it happened. You can't have rising private debt forever. When it stopped rising, the change in private debt, which is credit, goes from positive to negative. That's what happened back in 2008. And you then had the downturn. Now, but that's the same thing applied back in the Great Depression, with a much larger level of negative credit. But with all the effects of the Great Depression, including the New Deal and then the Second World War, that reduced the level of private debt in America from about 150% of GDP to about 40% of GDP. So you began the post-Second World War period, and I think in many ways COVID can only be repaired compared to the World War in terms of its impact upon the economy. You began that period with a very low level of private debt, nobody financially constrained, and credit could be positive and stimulate the economy, and you grew in the golden age of capitalism. This time round, the level of private debt's only reduced from about 70% of GDP to 150%, so actually more than the peak level during the Great Depression. So when we come out of this, if we come out of the coronavirus health crisis itself, and all the government supports that are being put there to get people through it to some extent are pulled away, they're going to be, many of them are not working, as you said. There'll be industries that don't exist anymore or have been more than decimated by the COVID crisis. They won't have the cash flows to service their mortgages. The banks might well find themselves in negative equity as well. So I think we're going to have a financial crisis as soon as all those supports are pulled away. It's a bit like the old the statement about you only see who's naked when the tide goes out. Well, the tide in this case won't be the financial system's woes. It'll be pulling away the government supports when they're still needed, and people have accumulated more debt just to stay alive during the crisis, particularly the corporate sector. So I think we could see instant bankruptcies. And I see a very sharp and sudden repeat of 2008 unless the government deliberately reduces the level of private debt, because that's my modern debt jubilee, and that has a slightly better hope than a snowflake in hell of happening, but it's still pretty much highly unlikely to happen. That's the only way I can see us avoiding a major financial crisis after COVID.
All right, and I want to get to the debt issue and your idea of the jubilee in just a second. Before we do, we talked briefly about sort of the the poor response to the stimulus to date, even though a lot of trillions of stimulus have been created. If you had been in charge, how would you like to have seen the government response been? I know it says you'd like to have seen more payments directly to people. Would you have printed as much stimulus, less? How would you have applied it? What would a good response have looked like?
I would have done more. I mean, we know that the only way to successfully knock the virus out is a lockdown, where you have only essential industries operating. Everybody stays at home until we can isolate which families have the disease. You do that over a 2-week period. You then have another 2 weeks where they are treated, and you then identify all the cases. A couple of weeks after that, it could have all been over. That's what's called the program put forward by Yanir Bar-Yam on his website, endcoronavirus.org. He's the guy who managed the response to the 2014 Ebola outbreak in Africa quite successfully. That's his guidance to what we should have done. So you would needed the government to provide people with financial means to survive between 6 weeks and 3 months of not working, meaning enough money to pay the mortgages, to pay the rents, so the landlords don't go bankrupt, and then the banks themselves don't end up going bankrupt as well. So I would have provided enough money effectively for, say, 3 months of America's GDP. Now that's about $6 trillion.
Okay, and I totally understand the logic behind that, and we may end up exceeding that, at the end of the day here, because it seems like both U.S. political parties have plans for substantially more stimulus after the election. But to people who, ask the question of, man, we were on shaky ground beforehand with, debts and deficit spending, and we were already in a deep enough hole. An additional $6 trillion, does that get us so deep in the hole that it creates an even bigger problem? What would your response be to that?
It's not a hole, it's a hill. And this is what's so frustrating hearing people talk about this, because let's say exactly the same thing. What was the hole you got poured into in World War II? Okay, and how did you come out of that hole? You came out on a mountain and you continued climbing up. The level of the deficit in 1942 in America was 30% of GDP. Now that's pretty much what I'm talking about here, 6 trillion out of about 20 trillion, 30% of GDP was the debt level. How did you pay for it? Simple, and this is where the accounting of what's called modern monetary theory is quite illuminating, and I've modeled this now in my own software package, Minsky, to show that their logic is correct. When the government runs a deficit, it's putting more money into private bank accounts than it's taking out through taxation. It literally creates the money we spend with a deficit. Simply by running the deficit itself, that injects money into the real economy. On the other side of the balance sheet of banks, it injects reserves. So if you had the 6 trillion I'm talking about, that would be 6 trillion additional dollars in bank accounts of firms and households and the private sector. And on the other side, there'd be 6 trillion in excess reserves sitting in bank assets. Now, when the government issues bonds to pay, people think they pay for with the bonds are purchased with the excess reserves. So the deficit both creates the money in the bank accounts of individuals and corporations, and it creates the reserves on the asset side of the bank's ledgers. And then when the bonds are issued, treasury bonds, which have a yield of 1 or 2%, let's say, when the reserves have a 0 yield, you're saying to the banks, hey guys, we would like to sell you $6 trillion worth of bonds that earn 2% interest per year. Would you like to buy them using the money we've created in your reserve accounts that are earning 0? Yeah. Now you'd need to be a non-greedy, stupid bank. There's plenty of stupid banks. There are no non-greedy ones. That's free money. You take it on. And when you look at the bonds being sold to the public, which people actually think, well, that takes money out of the private sector. Yes, it does. If you actually sell bonds to private individuals rather than the banks, then what that does is take money out of circulation. And that was why the bonds were sold to the public in the Second World War, because it reduced their spending on consumption items and left more of the money for the industrial military might to be built to fight the Germans and fight the Japanese. Now, exactly the same thing applies here. There's no problem in creating that. Creating that debt is creating a mountain of money in people's bank accounts. So your government can create that money pretty much indefinitely. It's then what are the consequences of that? Of course, we normally talk about that in the context of a close to fully employed economy, and that would cause inflation. That's seen as the negative. But if we're the economy we are now, which is, the GDP has fallen by about 30%, that would make up the 30% fall. So you wouldn't get inflation about it, you get a sustainable economy coming out of it. So there's no problem at all about that. That so-called debt is effectively an asset of the private sector.
Okay, so sadly, that's not what we did, right? So we weren't, very targeted in terms of, super lockdown for a short period of time and just kicking this thing. It's been quite prolonged. And the stimulus that's been unleashed, wasn't distributed in the way that you had said ideally it could have been. So as we look forward, as you said, debt to GDP ratios were crazy beforehand, crazier even now. And you mentioned earlier that you have had a potential solution, or at least component of the solution that you have been, I think it's fair to say, an advocate for, but correct me if that's an incorrect term, of a debt jubilee. Can you briefly describe for folks what you mean by the debt jubilee, and if it were to be enacted, how would it be enacted?
Yeah, well, we'd be using the same power that the Federal Reserve has used to do quantitative easing, but directing it at the people rather than at the banks. So if you look at what quantitative easing has done, that was $80 billion per month, every month, for about close to under 10 years. The Federal Reserve said, we're going to be on the buy side to the tune of $1 trillion a year in the open market operations they do with the banking sector. And how did they pay for it? They simply said, we're going to put $1 trillion in your reserve accounts at the Federal Reserve, and they're going to purchase $1 trillion worth of bonds off you and put them on our asset side. So it is simply bookkeeping. They create the money. Now, what I would have done with the modern debt jubilee is use the same mechanism, but have people having bank accounts at the Federal Reserve. So central bank digital currency, effectively. So everybody would get money put into that account. If the recipients were in debt, they would have to reduce their debt levels, private debt. They could not use it for spending. If they didn't have debt, it's a cash injection. And the proposal I had back after 2010 was to use this as a way to democratise share ownership as well, and to reduce corporate debt, so that if you had money, you didn't have debt, you got the cash injection. Let's say it's $100,000. Okay, that's a reasonable figure. As a ballpark figure to say per bank account. Then if you have debt, you pay it down by 100,000. If you don't have debt, you get 100,000 in cash. That would have been directed in my previous proposal to say you have to buy newly issued corporate shares, which are themselves used to pay down corporate debt. So you'd reduce both household and corporate debt that way, and you'd spread the ownership of shares throughout the population. Whereas, of course, they're now quite concentrated amongst just the wealthy. With the COVID, I would say that would be better to say let them spend the money as they wish, because you actually want that spending to happen, rather than trying to prevent it, as that mechanism I suggested beforehand would have done. So you can use, the central bank has an unlimited capacity to create American dollars. Use that capacity to create fiat-backed money, and use that fiat-backed money to cancel credit-based money. And by that way, we redress the big mistake we've made of letting the banks create far too much private debt. We get back to more of a balanced fiat and credit system than we have at the moment. That's my proposal. I'm certainly advocating it. I haven't bothered working on it for about 10 years because I thought it'd have a snowflake's chance in hell. We're now in hell, so maybe it's worth giving the snowflake a try.
I'm curious, Steve, has anybody come knocking on your door recently to say, hey, Steve, you put this idea on the table beforehand. Now we're in hell. We're in crisis. We're looking for a better way to do things. Is anybody, digging in?
This is the great frustration of watching people like Paul Krugman being actually a critic outside the government, and people like Laffer being advising it. And you think you got a guy who's got a half-baked understanding of the monetary system, being the recognised critic. That's Paul Krugman. And a total Fruit Loop advising the government, his advice being taken. So the ideas that we put forward, or I put forward, are seen as crank-based ideas, but the ideas that I've worked on are actually based on a sound understanding of the accounting and the monetary system. And that's missing amongst conventional economists who have habitually model the economy without money, without debt, and without banks. And then they try to tell us what to do about debts, debt, and banks and money. They haven't got a clue. So it's very frustrating sitting outside and watching the wrong ideas being tried. The only time I see policymakers doing the right thing is when they get hit by panic, and in panic they threw their textbooks out the window, and that's the best thing you can do with an economics textbook.
Just throw it out the window. All right. Well, real quick, we'll try to land the plane here quickly because it is very late your time. So two questions that I'll combine together for you. And you may have already answered the first one, which is, if you were in charge, what policies would you focus on implementing beyond the Jubilee? Because clearly it sounds like that's a big thing that you want to try. And then secondly, where is the hope in this story, if any, as you see it right now? You say we've turned it into a catastrophe, that we are in hell here. And we've just talked about the fact that from your lens, a financial economic crisis is looming ahead of us probably next year. Is it a short period of time that you see us getting out of eventually, or is this going to be a prolonged period, or whatever? Where do you see hope, if any, in this story?
Well, the only hope I see is that this is a warning from the ecology to us, saying your economy has overshot the bounds of the biosphere. Global warming has not caused COVID. But what has caused both global warming and COVID is excessive human pressure upon the biosphere. If you're a parasite, then the best host to inhabit is the dominant predator of the planet. That's us. Okay. There's no point inhabiting Siberian tigers because they're being driven extinct by us. So we've made ourselves the prime target for pathogens, and they don't have any morals. They don't have red or blue colours on their flags. They simply want us as hosts. So this is a warning to us of what's going to happen from climate change as well. And their economists have done a better job in stuffing up the economy than they did back in 2008 by completely trivialising the dangers of climate change. Now, this plus the wildfires, plus the floods, plus the cyclones you guys are living through, that's a sign that we really have to take the ecology seriously. Forget what the economists tell us, this matters, this is serious. So that the beauty of it in this sense is that we've had at least an early warning before we start seeing serious breakdowns to the climate, food systems and so on. And that could get us to reorient ourselves and say we have to restrain our impact upon the biosphere. The other positive is that at the same time as modern monetary theory has become quite popular, which is a totally new experience, the first time since Keynes, that a non-orthodox economic idea has got an audience in the media and politics. We're showing with things like the $2 trillion that the Democrats and Republicans are squabbling over right now, that there's no limit to the government's capacity to create money. Okay? It doesn't create debt, it doesn't burden future generations, and it doesn't take savings out of the private sector. So we've learnt that. We could apply that knowledge and we could apply it to finance what we need to do over climate change. Those are the positives. As to whether we'll learn from them, I'm sorry, I would expect to see pigs fly sooner than that.
Right. And I'm laughing, but it's more of a gallows humor kind of laugh. So, Steve, as you mentioned, we've known of each other's work for a long time.
Yeah.
Anybody that's followed Peak Prosperity knows our 3 E's framework, which says you have to look at the economy as being dependent upon the energy systems and inputs from the natural environment it needs to work. And as you said, so many conventional economists just look at the economy as a closed system and totally ignore the resources side of things, and that's at our peril, and it's manifesting in many of the ways that you mentioned. All right, so as we wrap things up here, Steve, 2 last questions for you. One is just sort of what's your general advice to one of our viewers here that's an investor, they're concerned about protecting and preserving their wealth, but they're concerned about the things that you've just mentioned here?
Well, I think the only viable industry we're going to see going forward is going to be stuff which is reducing our carbon footprint. Solar, potentially nuclear, those are the investment areas I'd be looking at, because we simply have to roll those out at a very dramatic rate. If we rely upon the current rate of growth of solar, it won't be till about 2070 or so that we would have 100% renewable energy. Now, that is far too late in terms of damage to the climate. So we're going to have to ramp it up by a factor of 4 or 5. If that means in terms of investment, it means money is going to be made by corporations producing solar, other renewable forms, and also producing nuclear. So I'd be putting my money in those industries, and certainly forget about coal, forget about gas guzzling by cars, and forget about real estate for a while. I'd be looking at the energy sector, renewables, nuclear.
All right, and Steve, you've mentioned a number of really fascinating ideas here. Your Jubilee, just one of them, and it's hard to do an idea like that that's got some complexity justice in a quick interview like that. So if people are interested in learning more about you, your work, I see your Patreon URL above your head there, so maybe they want to support you. Where should they go?
The best place is the Patreon page. I think there's actually, is that reverse for you? It's certainly reverse for me.
I can read it, so hopefully our users.
Okay, hopefully. So it's www.patreon.com/Prof Steve Keen. That's my main income source. Of course, I've got about 1,500 patrons supporting me there. When I first began it, I asked them, do you want my stuff just to be limited to patrons only? Would you like to be public? And they said overwhelmingly public. The only stuff which is limited to the patrons on my podcast with Phil Dobby. But otherwise, virtually everything there is freely accessible to the public. So you don't have to pay me money to use the site. I don't mind you doing that, but I want to get the ideas out there as well, and so do my supporters. So most of the posts there are free. I've got a lot of stuff in my old debt deflation blog that I haven't transferred across, and I've got a Prof Steve Keen website as well, badly organised. They desperately need some clerical assistance. But the patreon.com is the place to go to.
All right. Well, with that, Steve, we're going to thank you. We're going to let you finally get to bed because I know it's very late your time over there in Thailand. Keep staying safe. Thank you so much for coming on the program, and we look forward to talking to you again soon.
Keep safe, you guys, as well. You're in a much more dangerous place than I am.
Thanks, sadly. Okay. All right. Well,
thanks, Steve.
John and Mike.
Hi, Steve. Thank you very much. Be well.
Okay, bye.
You know, as expected, fascinating conversation there with Steve. Such a smart guy. You know, I find it so fascinating in the modern era. You know, we just had this huge kerfuffle yesterday with Twitter, basically preventing the New York Post from posting a story on Hunter Biden because Twitter deemed that it wasn't, I don't know what their exact terminology was, but it wasn't safe news, or that there was some veracity concerns about it. And of course, a huge issue about censorship, because the New York Post is, I think, the 4th largest newspaper in America. And if a private company like Twitter can really start stepping in and controlling for folks what it sees as appropriate versus inappropriate content, it's a very, very slippery slope. The point I'm getting to is that this is a world, whether it's politics, whether it's corporate interests, whether it's media interests or whatever, it seems that you really have to, you really consider the bias of your source. And it's interesting that platforms like Patreon are you know, helping sort of address that issue by giving people a platform where their direct audience can support them, and they don't have to have a corporate overlord or a government, you know, official or somebody kind of telling what they have to say. They can basically be free from that type of controlling bias. It's very interesting to me. But that's not what we're here to talk about. We're here to talk about what the markets have done in the past week. Mike, why don't we start with you? The past couple of weeks, we'd seen the markets basically just keep doing, you know, back to their inexorable march higher and higher, about 100, 150 S&P points a week without too many dips in the way. This week, I think, is a little bit different, but why don't you tell us what you've seen happen in the past 7 days?
Yeah, I was just taking a look at the charts earlier, and you know what we are right now on the S&P is relative to when we talked last week. Because I always look at the end of you know, where we are today versus where we were a week ago. So last Thursday, we were about you know, 15 S&P points lower. Now earlier in the week, we were higher on the S&P. We came out of the gates with a massive gap up on Monday, but here we are on Thursday afternoon. We're only up about 15 points, so it's basically flat versus last week. Also, gold and gold miners are about flat versus last week. So all in all, it looks like nothing much has happened. But if you step back and take a look at the daily charts, you know, we have, believe it or not, you know, another potential island reversal, you know, here over the last few days. Monday was a big up day, gapped right out of the gates, one of the strongest days in quite a while. And we poked out of the kind of the uptrend channel that this market has been drawing out for many, many months, and traded sideways for a couple of days. And, you know, as of right now, we've got a slight gap down today. So it's really early. We're certainly not trying to predict anything here, but it's another island reversal, just like we saw back in June of this year. The interesting thing is that I don't really see anyone talking about this. You know, earlier in the year in June, there was much more kind of buzz about, you know, an island reversal, gap down. these are pretty powerful signals from the market when you see island reversals, and maybe it's even more apropos when no one's talking about it. It's always, seems to be that way with technical signals. So really early still. We think some early signs of caution. Market's flat week on week. Other things continue to scream caution to us. Really historically low put call ratio. The put call ratio reached a year low the other day of 0.31. Just means a lot more people are buying call options, which is a bullish bet, than are buying put options, which is a bearish bet. So really not much need for protection is what the market participants are saying. They're not worried about downside. Of course, we are worried about downside. We've been worried about downside for a very long time. We still think this market's trying to trace out a top going all the way back to the blow off in January of 2018. So a good 2.5 years ago. So we continue to be cautious. Some early signs of some cracks and some additional caution this week.
All right. Yeah, it's so, what's been driving the markets for the past several weeks, as we've been talking about, is pretty much just been expectation of stimulus. I think maybe part of what the cooling off this week is due to two things. One, by any metric, the markets had gotten really overbought over the past couple of weeks because it had just been, a straight rocket ride up, particularly in the past week. But also some of the latest headlines are a little bit more disappointing. And I think, personally, it's going to be unrealistic to expect much to be decided politically now between now and the election. I don't think either party wants to look like they're compromising or giving even a partial win to the other side before votes are cast. So, we'll see, but my guess is the market is, probably beginning to wake up to it. It's not going to get anything before the actual election itself. Mike, you mentioned the potential island reversal and the gaps. One person who has been writing about the gaps is our friend Sven Henrik, the technical analyst. He just published a piece the other day called Mind the Gaps.
Mind the Gaps.
Yeah. And talking about a lot of gaps that have opened up, in the S&P beneath where we are right now, and also in the VIX above where we are right now. And as we've talked about in this program a number of times, there's an old saying in markets, which is that gaps tend to fill. Market wants to fill those gaps. And so if those gaps do start getting filled, then that would be a bearish development because that's the direction in which the gaps are open. All right. One other thing that I think is also contributing to the weakness over the past yesterday and today is that Goldman came out with a report downgrading big tech to neutral. I haven't had a chance to read that report yet, but Goldman's opinion does carry some weight. And I do think relevant to the point I made at the beginning here about the kerfuffle with Twitter yesterday. Increasingly, big tech is beginning to really get stuck in the position of the bad guy, particularly around access to information and, of course, information that it collects on people. So many people have seen the popular documentary on Netflix right now called The Social Dilemma, which really is beginning to sort of change the conversation around big tech. It really dives into exactly how it's manipulating us and our children. And then with the election here, it's been hard for Twitter and Facebook not to find themselves being put in the position of being accused as an unfair censor. And certainly given what Twitter did yesterday, they did not help their case there. And increasingly, especially in regards to yesterday's issue, there are some politicians that are coming out saying that they are now gunning for the tech companies. And we've been talking over the past months about legislation that's being considered for investigating these companies. Are they violating antitrust? Should they be broken up or at least reduced in scope? I think you're seeing additional enthusiasm build on Capitol Hill for putting some real serious constraints on these companies. So it'd be interesting to see going forward. But I think investors are beginning to get their initial worries that the darling companies of the past several years could actually begin to be in some real trouble going forward. John, let's switch over to you because you sent me a tweet right before we got on the program here. I'll just let you comment to it in terms of anything that you want to say for why you sent that over.
Yeah, I'll add a couple quick things to what Mike already elaborated on. The recent spike higher and then the recent pullback in the broad stock market, S&P, for example. Very much very well could be a blow off top. Some anecdotal things. And I saw an interview with I think Bill Smead from Smead Capital Management. He commented not only about kind of forward PEs at 22, well higher than what is the 10-year average, and that's not even a measure we like, frankly. But he commented about the degree of really short-term bullish call option buying, which is a very levered way to play a move higher in the stock market. And he put some numbers around. He said there's on the order of 500 billion right now of short-term call buying, and which is off the charts. Just comparatively in the peak period around the 2007 market top and the 1999 market top, that was more like 100 billion. So there's a whole lot of speculative kind of uber bullish behavior out there that is very much oftentimes signifying a kind of blow off top frenzy, if you will. But yeah, I mean, broader speaking, one of the developments in recent days has been kind of the decline in yields. Not so, U.S. Treasury yields haven't declined so much, but you look over, for example, in the Eurozone, the yields are plummeting. For example, Germany just I think today hit negative 0.2% on their 30-year government bond. These are the kinds of moves, and I should say this is despite massive amounts of fiscal stimulus already announced by these Eurozone governments. I think, for example, Germany, I think we will have the charts that I sent you, Adam. Germany, through I think September 11th of this year, announced something like the equivalent of 40% of their GDP in the form of fiscal stimulus. So with these big bazookas blaring and yet yields still kind of turning down like this, it's not a very encouraging sign. This is dropping yields like that is very much, at least traditionally anyways, associated with very pessimistic views on growth. And just kind of commenting on the market, this year and in the context of the economy, if you look at, broad global stock markets, basically, I'm looking at a chart here, and I shared this with you, Adam. I think it was through just yesterday, maybe. Global stock markets were up, something like 6.6% on the year, but earnings per share are down over 20%. So basically, we have over 20% margin expansion in PEs on an over almost 20% decline in earnings. That is, a very much a, kind of divergence of fundamentals in reality, markets in reality. Even last year, for example, where the multiples in the market were something like, 30% year-over-year increase in expansions. At least earnings were flat last year. They didn't grow, but they were flat. This year, they're down considerably. So there continues to be just a widening chasm between markets and what markets are pricing and the economic realities.
All right, so it's so interesting because everything you just mentioned there, John, we've got our seminar coming up, our digital seminar on October 24th, 25th for peak prosperity that I've talked about in past episodes here. And so I've been very busy helping a lot of the main speakers record their presentations for that. And it is amazing. I mean, the time in which we find ourselves for virtually every single economist, Fed expert, market technician, whomever we're having speak at this conference, they're saying that this is the most precarious time they've ever seen, both in terms of the damage done to the economy, but to the disconnect between what the financial markets are telling us versus what the actual economic data is telling us. And of course, you just dialed through several good examples of that. So it really is like living through history. As Steve said, there's definitely going to be some ripple effects and serious repercussions from all of this that we're going to be continuing to feel going forward into 2021 from here and probably for many years thereafter. But right now, it does have that sort of weightless feeling of when the car has gone off the cliff, and you can think ahead to what's going to happen in just a split second, but at that moment, the car is still weightless and, everything feels fine, but your gut is telling you that it's not going to be very fine in just a short period of time. So, all right, guys, let's wrap things up here because I still have a number of those presentations to help get coordinated for the conference. I know you guys have a lot of work too. You guys have been telling me that you've just been having a ton of people reaching out to you, opening accounts and whatnot, that your own business as a barometer of sort of investor nervousness seems to really be sort of pegged to, very heavily on the extremely concerned side. Is that true, John?
Yeah, very much is. And look, folks that reach out to us, they got busy lives. And I mean, in fact, that's probably why they're reaching out to us. They don't have the time, nor many of them the time nor interest in really watching like a hawk their very important financial, savings and investments and whatnot. But I think what we're seeing here is the ebbs and flows of activity of folks reaching out to us oftentimes are related to just broad senses, spidey senses, I might even say, about things not being right, whether it's markets starting to falter or get, obviously over exuberant to even the layperson, or, I think the election and the unsettledness of what's going on around that has got a lot of people really concerned. It's quite possible, likely we would say, that no matter what happens with the election, there's going to be some kinds of fireworks in markets, probably even society, given how divided this country is right now. So yeah, we're getting a lot of folks just with their spidey sense reaching out that things just are unsettled and they want to batten down the hatches.
All right. Well, look, if you're watching and you're feeling that level of unsettled discomfort, certainly consider coming to the seminar if you haven't registered for it already. I'm going to put the URL back up on the screen here. But in addition to having amazing presenters on the money side of things, Mike Maloney, Chris Martenson, Sven Henrik, Danielle DiMartino Booth, Axel Merck, John Rubino, Charles Hugh Smith, Wolf Richter, I could keep on going. We're also going to have an interactive session of the weekend where it really is just a money Q&A, where we're going to have a panel of experts inclusive of John and Mike here from New Harbor, but we're also going to have experts in real estate, in precious metals, in how to invest in farmland, tax experts, estate planning experts, and we're just fielding whatever questions folks have. So it's your chance to go in and ask any question you want of a smart, well-diversified, money-based panel like that. In addition, because it's not all about just talking about our problems, it's a 2-day event. The second day is completely dedicated to solutions, like what should we do about all this? And there's some recommendations about what to do with your money, but there's a whole host of recommendations about what to do with your home, your health, your community, all the other important elements of wealth that are separate from just the dollars in your bank account. All right, and so guys, as we get ready to wrap up here and plan to see each other in 7 days, and we're going to do this again with next week's guest, who is a great guest. I'm going to announce it as I usually do on Twitter. So if you haven't followed me on Twitter yet, take a minute and do that. It's @MenloBear. As I mentioned, I like to share who our future guest is in that channel. I don't do it on these live videos just in case people's schedules change. But I'd love to share that with folks that are interested, but I also love to hear suggestions from you as who you would like to see as a future guest on this program. Steve Keen was somebody that a number of people had been asking me for, so that's an example of somebody that we went out and got based upon your feedback. Secondly, if you haven't already yet, please just take a quick second, like the video. The number of likes these videos get actually does make a big difference in terms of how much YouTube shares them, and that is a function of the big names we're able to get in the program. So your likes help us get those big names. And then last, as we say every week, if you are interested in not just getting information passively like this, but talking to a financial expert that understands these risks and can look at your own personal portfolio and either give you advice on what to do with it, or perhaps take over management for you if, as John said, you're a busy person with busy lives and would rather have a professional manage things. If you already have a good one, great. Just make sure you're, especially at this rocky time and uncertain time, that you are in conversation with them and know what their plan for your money is. And if you don't have one, or you're having trouble finding a good advisor in this space, John and Mike here, they're the lead partners of New Harbor Financial. We have worked out a relationship with them where we send concerned investors to them, and these guys do a completely free, no strings attached, no commitment involved portfolio audit. They'll walk through all your personal accounts with you. They'll give you their advice. And if that's useful information and you want to go do something with it on your own, great. Or if you'd like to work with them, the door's open for that too, but it is not, it's not required for having that conversation. If that's of interest to you, just stick around to the end of the video. We give you all the details on how to do that. And John and Mike, I want to thank you guys for yet another week of this. Way too early to say. You guys mentioned, maybe these are the last, minutes of a blow off top. I think we'd all like to see that in terms of getting back to a return of prices that are a little less out of control, but way too early to predict that. So as we do, we'll be watching these markets daily going forward. And with that, guys, we'll see you next week.
See you next week, Adam. Thanks.
Thanks, Adam. We'll see you guys next week. Thanks.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.